Another week, another plot twist in the global markets. Tech stocks stumble, the U.S. government shutdown finally ends, consumer sentiment hits a 3-year low, and investors are left asking the same question. Are we heading for a soft landing or a slow bleed into 2026? This is your Finance Club weekly briefing. Let's break down exactly what happened and what you need to prepare for next week. U.S. stocks closed the week mixed, and that word mixed might undersell what actually happened. The Dow Jones climbed 0.3%, the S&P 500 nudged up 0.1%, and the tech-heavy Nasdaq fell 0.5%, clearly showing a rotation away from high-valuation tech. Why the divergence? Because this week was dominated by three forces: overvalued AI stocks, shutdown anxiety, and consumer pessimism. After weeks of tension, the longest government shutdown in U.S. history finally ended Wednesday. Congress approved a funding bill that carries us through January 30th, 2026. Federal workers are breathing again, government services are restarting, but economists warn the damage is done. Q4 growth forecasts have dropped to 1.0% to 1.5%, almost half of earlier expectations. Businesses delayed projects, federal workers cut spending, and uncertainty froze investment flows. This wasn't just a bad week. Consumer sentiment fell to a 3-year low. People are nervous about jobs, inflation, and the ripple effects of the shutdown. That anxiety hit retailers and small-cap stocks especially hard. Let's talk tech, because tech was the problem child this week. Investors are suddenly questioning AI spending. Companies are pouring billions into hardware, data centers, and model training. But revenue hasn't caught up yet. This triggered a rotation. Money flowed out of AI, semiconductor, and cloud stocks, and moved into defensive sectors like healthcare, energy, and materials. For the first time in months, the market is asking, is AI overvalued? Are we in a mini-bubble? This correction may be a preview of what's coming in early 2026. Globally, the story wasn't much better. Europe and Asia had a choppy week, with most major indexes slipping. Why? Because the U.S. tech sell-off spilled everywhere, and rising energy inventories pushed oil down for a second straight week. Oil prices continued their downward slide, pressured by rising U.S. inventories, increased OPEC plus production, and fresh price cuts from Saudi Arabia. This is great news for inflation, but troubling for energy producers. The Nasdaq is still leading year to date, but the red candles this week show a market losing confidence. Next week, investors will be watching 5 things closely. 1. Shutdown fallout. Federal agencies rebooting will give early clues about Q4 damage. 2. Labor market data. If job numbers weaken, recession talk returns. 3. Tech earnings and AI costs. Big tech is spending like a gold rush. Investors want to see profits, not promises. 4th sector rotation. Expect more money flowing out of speculative tech and into safer plays. 5. Oil price movements. A deeper drop in oil could boost consumer confidence or crush energy companies. Volatility isn't going anywhere. Here's the smart money approach. Stay balanced, leaning slightly defensive. Avoid overvalued, profit-light tech. Seek value in healthcare, energy, materials. Look for buying opportunities in beaten-down but fundamentally strong companies. And above all, don't chase hype until earnings catch up. The markets this week reminded us of one thing. Confidence is fragile, and money always moves before the news hits. Stay alert, stay informed, and stay ahead. This is Finance Club, where the first rule is, we talk about money. See you next week.